Okay, so we're going on with debt. So I'll just show you a couple examples of debt. Now, debt is called leverage a lot of times. So if this is a rock, and the way you can move the rock is by having the human being come over here, and using a lever, you can push this thing up here. But what's unfortunately happening to the middle class is they're over here carrying the debt. Does that make sense, you guys here? Yeah. So debt can be positive leverage or negative leverage. You can also use too much leverage and it falls apart on you. How many people ever use too much leverage on a deal? I have. And the way you know when you have too much leverage is called the sleeping principle. When you can't sleep at night, you use too much leverage. So, anyway, I'll just give a few quick examples of how I use debt. It's really simple. And so let's say I want to buy a $100,000 house, condo, or whatever it is. Okay? And so what I do is I put $20,000 down. They call it a down payment. I call it equity. This is my skin in the game. I'll put $20,000 down and very simply finance the rest with debt. Now, the reason I like this money here, or my banker's money, is really simple. It's tax-free money. This is called debt. I don't have to pay taxes on it. This is absolutely wonderful. If you're, the average tax rate is about 50% with all the hidden taxes and all this, the state, local, state, federal, and then all the other taxes that they sort of shift away from you. So to get $80,000, I just simply double it. And I say what it really means is I'll really need $160,000 in earnings to cover $80,000. That makes sense, you guys here? Because taxes will take 50% of it. So one of the ways I'm getting hit faster is I want to use higher debt ratios. But the higher the debt ratio, the more certain on the deal. And by number 10, you'll understand how it comes together. Also, if I use more debt, does my return on investment go up or down? Up. The more debt, the higher the return. So if somebody says they're getting 8% return, I go, what a loser. Why would you lose it? Why would you get 8%? For example, let's say those pizza restaurants I was buying, each one's $1 million, let's say. I put no money into it. It puts $40,000 in my pocket. In other words, I've used $1 million worth of debt. What's my ROI? Infinity. I have no money in the deal. I make higher returns on my investments. All these losers in the stock market, 8% return, 12% return. It's taxable or no, whatever it is. But it's not enough of a return. So debt can increase. The most important thing is your ROI or your return on investment. But that requires financial IQ. Okay? Really simply that. I don't expect you to understand it right away. But that's why I'm always looking at how much can I borrow, not how much can I put into it, how much can I save. There's one more factor that makes a very big difference in financing or understanding why the rich get richer is when you look at this financial statement right over here, the word again here is cash flow, not capital gains. You see, the guys who flip properties, they're capital gains guys. Look how they do it. And the guys who buy stocks to sell low, buy low and sell high, that's capital gains. But cash flow, the reason the game is called cash flow is the key. If you have cash flow, you win, 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 win. It's harder to find a cash flow deal than to find a capital gains deal. That's why it takes more financial IQ. For example, when I go to these realtors and I say, well, what's this house worth? They say, oh, it's only $1 million or $500,000. I said, yeah, but you should buy it. Let's say it's $500,000. It'll go up to $1 million in 2 years. I say, well, you guarantee that? And what the realtors and stockbrokers and all these brokers, and the reason they're called brokers is because they're broker than you are, is they're talking about capital gains most of the time, not what? Cash flow. To find a cash flow deal requires a higher degree of intelligence, looking, creativity. Creativity is a key word in there. Okay? So, when you look at income, expense, asset, liability, one of the reasons I like to use my banker's money, and let's say it's $1 million, I'm borrowed from the banker, right? And let's say it's now putting $30,000. My real deal was $8 million, my ice deal. It puts $30,000 a month in my pocket, okay? Of this income, the $30,000, how much does the banker get? Zero. Banker doesn't share in this. I love my banker. What a great guy. I use his or her money, borrow the crap out of them. I make this money. But also, cash flow is I get a thing over here called depreciation. I get to depreciate the building. It's component depreciation. So, in other words, what they say is the building is going down in value. Now, is the building going down in value? No. In most cases, at least the properties I buy, it's going up. It's appreciating, but because the IRS is such a great organization. They are. They're wonderful. When I hear people complain about taxes, I go, because you're a loser. You know? The IRS lets me depreciate a building that's going up. That makes sense to you? And that's called appreciation. This is where vocabulary and words and the right brain pictures and clarity come in. Oh, I'm getting appreciation also. Now, does my banker participate in that? No. Bless his soul. Does the IRS participate in that? No. So when you look at it, the reason real estate or a business, you can do this in business also, the reason on the B and the I side is a much better deal is you can make a lot more money using my banker's money. I have 4 sources of income. Not only that, who pays for this mortgage? My tenant pays for this mortgage, and that's called amortization and amortization. So that's why when somebody says, are stocks, bonds, mutual funds good or bad? I'm going, well, this to me is superior. My banker doesn't ask for any of this. If I sell my apartment or this thing, and I 1031 it tax deferred into another project, I never have to pay for that depreciation either. I don't have to pay it back. So there's 4 sources of revenue: income, depreciation, appreciation, amortization. The bank does not participate in. Bless their soul. And that's why the rich get richer. Does that make sense, you guys here? Now, this is the last gig I have at all the stock guys, those financial planners. You know, they say, put your money in a mutual fund. Okay? Loser. But anyway. Will my banker lend me $8 million from mutual funds? No, not for 30 years. Will they lend me $8 million to buy bonds? No. They may make margins and, you know, stuff like that. But that's why, to me, stocks, bonds, mutual funds, the riskiest of all investments, very simply because your banker won't lend you money on them. There's one more thing that's even better about the thing, and it's an expense. It's called insurance. My tenant pays for the insurance to protect my assets, called CYA, cover your assets. The tenant pays for that. Will your banker, will your insurance agent insure your mutual funds? No, because they're too risky. You know, if you lose all your mutual funds, will the insurance company give it back to you? No. That makes sense, you guys here? So most of this, if you understand it, can be tax-free money. It's all cash flow. That is a very, very big difference. That's why the rich are getting richer, why I love my banker, and why I love the Internal Revenue Service. Now, if you don't understand this right now, don't worry about it. You know, again, 90%, you know more than 90% of the population. Again, not saying much, but at least you can understand it. The more you play this game, the more you understand how this is working, you will see things other people do not see. That's why it's called clarity. Make sense, you guys here? And that's why today, this is called the velocity of money. I simply borrowed, you know, the last example, I borrowed $1.2 million out because of the appreciation. How did I increase the appreciation? By increasing my rents. I have total control over all this. Mutual funds, you have no control over this, 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 or this. Stocks, you have no control over this, 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 or this. Index funds, you have no control over this, 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 or this. That's why those things are for people without much financial sophistication, low financial IQ. They're perfect. I'm not saying they're bad or good. If you have a low financial IQ, buy stocks, bonds, mutual funds. It's perfect for you. But if you want higher returns with less risk, like having insurance on things, this makes more sense to me, but you got to do your part of it, which is stay financially educated, stay abreast. I don't expect you to understand this right now. I don't, but that's what I have CPAs explain it to me. But I ask them, I tell them, I don't know. That's true. That's all I do is ask them, how does this? How can I maximize this? How can I minimize this? How can I do this? How can I borrow my money out? So my banker and my accountant and your Internal Revenue Service, my best friends. They're here to make me rich. Thank you very much.